In this week's video, we'll review the latest charts and data to help us understand which long-term market trends are holding up best: tech, gold, small caps, or foreign stocks. If you've been looking at your account balance, you know the markets and our positions have been performing well. And as of Friday morning, there was a 97% probability that the Federal Reserve is going to cut rates a second time on October 29, 2025. Since all investing is about opportunity cost, this week's video is based on an analysis of 388 ETFs, covering for the most part every investment option or bucket that you can think of. The chart on your screen is a monthly cloud chart of ACWX relative to SPY. This is global stocks ex-US, aka foreign stocks, relative to the S&P 500. On shorter term time frames, calendar year 2025, down here, lower right-hand corner of your screen, foreign stocks have been performing well. Yet on a longer term basis, they're still going 0 for 5 relative to the bullish boxes that we would like to check on the monthly cloud, which helps us monitor, in this case, the long-term relative trend. And while foreign stocks came out of the gate in 2025 very fast, since the S&P 500 bottomed in April of this year, they've been underperforming. And as you can see, they really haven't done anything on an AWAP chart, an anchored weighted average price chart. That's the colored lines. Really haven't seen anything yet that indicates anything other than an existing downtrend with normal counter-trend rallies. Our assessment of the probabilities would shift if the ratio can get out into this region here. The longer it stays there, the more relevant it would become. If you prefer to look at foreign developed markets, this is EFA in the ETF world relative to SPY. Heaviest weights in EFA: Japan, UK, France, Germany, Switzerland, Australia. If we look at the AWAP chart, we're looking at the trend EFA relative to the S&P 500 or SPY. Very similar situation. And everything that we said about the prior chart applies to this chart. Also noteworthy, unlike the S&P 500, the top sectors in EFA, financials, industrials, and healthcare. Tech only represents about 8% of EFA. And in the U.S., the financial sector, XLF, looked pretty good earlier in 2025. But if we look at it in early October, this chart looks like it's potentially breaking down. You don't really have a strong preference for SPY or XLF as long as we stay inside of this box. So ACWX is the very broad foreign stock picture. How about if we get specific and look at China FXI relative to the S&P 500? Looks a little better, but really hasn't done anything in terms of flipping the trend relative to the AWAP line here tied to this peak in 2021. This is FXI relative to SPY. The outperformance ended on March 18th of 2025. Back to the monthly cloud chart of ACWX relative to SPY. If we add a trend line and look at the same chart as of October 2nd, 2025, you can see we are bumping up against that trend line, somewhat similar to this period in here, telling us to keep an open mind, potentially, about the ratio moving into this area here. We'll see how it unfolds. And as time goes on, it can help to look at these ratios on different time frames. This is a daily chart of ACWX foreign stocks relative to SPY, the S&P 500. You can see the underperformance that's been taking place since the S&P 500 bottomed, made the less bad tariff news low in April of this year. But you can see the 200-day moving average here in gold is turning up. So we should keep an open mind. And it would be significant if this ratio can get into this area here and exceed this high. Since we trade the chart in front of us, we want to see that happen. Back to monthly cloud charts. This is AIQ, global AI and tech relative to SPY, the S&P 500. If you look at the boxes over here that we want to check from a bullish perspective, you can see we have some significant improvement. The fact that price and the green span are above the cloud and the cloud is flipped from red to green, that's a good sign. Next step would be to see these spans separate in a bullish manner, which means we'd like to see the blue span above the red span. We'd like to see both of these spans get above the cloud. This has an early stage trend look with the span, the ratio, and the other two spans all near the cloud. Thus, this is an improving and impressive chart that still has some work to do. Back to the US, this is FTech in the ETF world relative to VU. If you're relatively new to ETFs, SPY and VU are basically identical. VU has a little bit cheaper expense ratio. Now, this is a good look here. We had this period of indecisiveness and consolidation. It looks like the monthly chart is trying to break to the upside, and it too has that early stage trend look. Very similar situation with XLK. You can see this consolidation occurred below the dotted lines. This consolidation, for the most part, is occurring above the dotted lines. Different U.S. tech ETF, IYW relative to VU, U.S. tech relative to the S&P 500, an improving and emerging resumption of the bullish trend look here, with the ratio making a new high above this high that dates back to 2024. This too is a monthly chart. Remember, we said one of the things holding back many foreign ETFs, foreign mutual funds, maybe foreign options in your 401k, are the sector weightings. Only 8% or 9%, that range in EFA, which invests in these countries here, in the tech sector. If we look at another global tech ETF, AIQ was global, IXN is also global. So this is global tech, IXN relative to VU, the S&P 500. This too is an emerging and bullish look. Looks like we're trying to resume the uptrend that began back in calendar year 2016. That would be the good news for IXN. The bad news would be it still has a lot of work to do relative to U.S. tech. This is an AWAP chart, so an anchored weighted average price line, this blue line here, anchored to this point here in 2017. IXN Global Tech relative to XLK looks like it may be trying to get ready to move in this direction, but we trade the chart in front of us, and thus far, this still looks like a downtrend. This is AMLP relative to VU. AMLP, Master Limited Partnerships tied to energy infrastructure. You can see they were very, very popular when market participants were concerned about all the money printing that was going on, all the stimulus, and all the checks in the mailboxes. It appears that that fear is waning. We all know technical analysis is about subtle shifts. This has been basing in here since 2022, and now it's below this box up here, if we drew a box, back below the cloud. Instead of having an emerging bullish look like those relative tech charts have, this has an emerging and shifting look that looks like we're shifting from this uptrend to potentially resuming the long-term downtrend. Notice how all of the spans, the green span, the blue span, and the red span, are all near the cloud, and the same can be said for the ratio. So this is still an indecisive look, and you still have a green cloud. If we look at the AWAP lines, tie this one back to 2017, this one back to 2020, you can see in here the orange line, resistance, resistance. We did look like we were getting a breakout here earlier in 2025 with the tariff scare, but this is a failed breakout look now in 2025 and a sharp reversal. We did something similar back here and the uptrend resumed. So this too is still indecisive, but telling us to keep an open mind about a break to the downside. A lot of emerging trends that we're monitoring for clients. It's possible we could make some shifts with our allocation. This too is an emerging look, kind of drifting above this region of prior resistance. All of the spans, all three of them, are above the cloud, and the cloud is flipped from red to green. This is GBTC, Bitcoin, relative to the S&P 500. At the moment, checking all of the bullish boxes. Green span in the cloud, blue span in the cloud, red span in the cloud. That all speaks to indecisiveness in terms of gold relative to the S&P 500. Probably would classify this one as still favoring the upside. The blue span is well above the red span. Price has spent more time above the cloud right here and right here than any time in the rearview mirror going back to 2014. And this thick cloud that represents potentially strong resistance has flipped from red to green. Now this thin cloud tells you that the support below this ratio isn't great. We own a relatively small weighting, not carrying a heavy weight, but in no rush to get rid of gold, and frankly in no rush to add to it at this point. It would be easier to add if we could exceed this closing high here from earlier in 2025, and if all three of the spans could get above the cloud. Gold mining stocks, GDX, have been killing it, but you could have said the same thing from this low in 2018 to this high in 2020. This is GDX relative to SPY, gold mining stocks, relative to the S&P 500. This is a monthly chart with the 50-month moving average. You can see the 50-month tried to turn up here unsuccessfully. This one looks a little more convincing, telling us to keep an open mind about this ratio eventually clearing this high from 2014 and 2016. But this also falls into the category of a long-term range. There's no convincing evidence here that says I would rather own GDX on a long-term time frame relative to SPY. And when that's the case, you're better off being diversified in SPY. Some good things happening here, still has some work to do. A good next step would be to see a monthly close above this high back here on the ratio from 2020. Now, if we look at the physical gold ETF, GLD, relative to SPY, also a monthly chart with the 50-month moving average, you can see the 50-month does have a positive slope, which says the probability of getting a breakout into this area here is higher today than it was back here when you were trying to do that with a negative slope on the blue 50-month moving average. And notice here, when we were above the 50-month, it was almost like a magnet pulling down price. Look at all the white space in here. This looks a little more convincing, but it's still a range. We own GLD, we own SPY, and there seems to be no clear advantage in the short run, and thus we're comfortable holding both. If we look at a longer-term chart of physical gold relative to the S&P 500, it's a monthly chart dating back to 1968. This tells us on our time frame we would like to see more before we consider adding to our relatively minor weighting in gold. A good next step for the ratio would be to break into this white space here. It would be even more convincing if you could get here and then get a closing high above this high from 2011. That may happen, and it may happen very, very soon, but we all know we trade the chart in front of us. Similar story here. Spans in the cloud, span in the cloud. In a range, software stocks relative to the S&P 500 since this point here in 2023. I would read this as indecisive, but it still feels heavy to the downside at the moment. Cloud hasn't flipped from red to green yet. The blue span has given up the red span. And we remain below today this high, and this high. Our read would be we're in no rush to add IGV software. We'd be more open to it if it can get out into this region here. Improving? Absolutely, since this low in 2022. Value stocks, IVE relative to VU. Batting 0, 0 for 5 on the monthly cloud. In the grand scheme of things, simple is always better than complex. We want to invest in things that go from the lower left to the upper right. And we would like to avoid counter-trend rallies within the context of things that move from the upper left to the lower right. This is IWM relative to SPY, batting 0. Same old story, same old song and dance. If you look at IJR small caps relative to SPY or SPSM small caps relative to VU. The chart in front of us, the AWAP chart, small caps relative to SPY, remains in a downtrend. We would reassess the probabilities if the ratio can move into this area here. The last thing the ratio did was make a new low. There's a lot of information in this study, 1980 to 2020. They studied stocks in the Russell 3000, which is basically everything. Large caps, mid caps, and small caps. In this window, the median stock lagged by 54%. 42% of the 3,000 stocks had negative lifetime returns, telling you how hard it is to be a good stock picker. And 40% of the stocks in that window suffered a catastrophic loss, falling 70% or more. And this is the big takeaway. Only 7% of the stocks produced the gains in the index. There are other studies that say roughly 90% of portfolio variance is based on the buckets that you're in rather than the individual securities or bonds that you pick within those buckets, telling us that 90% of the battle is your asset allocation. How much are you allocating to each bucket, not the individual securities within the bucket. That's only about 10 to 12% of the variance of your returns. Thus, if you're using broad ETFs, you're focusing 100% of your efforts on 90% of the battle. Individual stocks, you can end up losing money when the market is making a lot of money. That's a cardinal sin of investing. We want to take what the market's willing to give. We've covered small caps. How about mid caps? Unlike the tech and growth charts that are moving from the lower left to the upper right, mid caps are moving from the upper left to the lower right. Chart dates back to 2017 and goes all the way to October 2nd of 2025. We've got that emerging and improving look. Large cap growth relative to the S&P 500, IWY in the ETF world. Look at the three spans, green, blue, and red, how far they are above the cloud. Batting 4 for 5 over here, and we just printed a new monthly closing high. Not as strong as QQQ, but 1Q also showing an improving look on the monthly cloud relative to the S&P 500. The QQQs, longer term from 2016, moving from the lower left to the upper right. All three spans well above the cloud, and the ratio above the cloud, well above the cloud, and making a new high. How about the rest of S&P 500 sectors? RSP, the equal weight S&P 500, relative to the standard capitalization weighted S&P 500, VU or SPY in the ETF world. RSP, the equal weight relative to the standard weight, batting 0 for 5 on October 2nd. What does that tell us? The capitalization weighted index is heavy tech. Much lower weighting to tech over here in RSP. SPY, the standard capitalization weighted index, has a much higher exposure to communication services, which for the most part is tech, relative to this weighting over here in RSP. And RSP has a much heavier weighting to industrials relative to SPY. There's a lot of information if you look at these weightings and this chart. Semis SMH relative to VU, SPAN A, SPAN B, SPAN C, and price, all well above a green cloud. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. We have a little bit of an overshoot here, and now we've printed a higher high above this level here. This too has an emerging resumption of the uptrend look on the monthly cloud. SCHG is in George relative to VU. Growth versus value. Value killed growth when market participants were concerned about inflation, interest rates, and Fed policy in calendar year 2022. Today, on October 2nd, 2025, early in October, this is being recorded on Friday, batting 1,000, 5 for 5. All three spans and the ratio well above a green cloud. This is what fear of inflation looks like starting in 2020 and ending in 2022. This is what calendar year 2025 looks like. This has an emerging rollover look, still indecisive. Looks like we're trying to resume the downtrend, the long-term downtrend of energy stocks, XLE, relative to VU and or SPY. If we zoom in here, the cloud is just now flipping from green to red. Defensive staples relative to VU and or SPY. The chart would look identical if we plugged SPY in there. Already underperforming in early October, batting 0 for 5 on the monthly cloud. If 7% of 3,000 stocks are for the most part carrying the entire index of 3,000 stocks, then it's good to know that 7% of 3,000 is 210. How many holdings are in IYW, SCHG, XLK, IWY, and SPY? Answer, 140, 195, 72, 115, and 500. If this is where your return comes from, these type of ETFs, investing in tech and growth stocks, pass the common sense test of being leaders within the context of a tech bull market. And remember, this is an opportunity cost analysis, so we're looking at every single asset class, every single way that you can slice and dice it. And we're covering the best of the best on very long-term time frames. Why long-term? Because the evidence that we have in hand says we're in a secular bull market. And we know at some point there's going to be 100% normal and to be expected givebacks. And we also know if we try to take what the market is willing to give, history tells us within the context of a secular bull market, what the market is willing to give can be very, very attractive, even at this stage of a secular bull. If we can capture at or near or slightly above market returns, we should be very, very happy. And this data tells us that we don't have to get overly concentrated to make that happen. More concentrated? Yes. Overly concentrated starts to add in some additional risk into the equation. The visual on October 3rd at 10:28 a.m. Eastern Time says secular bull market. The data that we have in hand says secular bull market. Data on your screen as of October 3rd. The strength of the trend says secular bull market. But we all know the only way we're going to identify a potential turning point is if we're willing to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.